Joining us now is Michael Darda, the chief economist and market strategist at Roth, along with CNBC senior economics reporter Steve Liesman. It's great to have you guys both here. And Steve, if I could just set the scene for us. We are starting to hear anecdotally, and maybe now in the data, ADP yesterday was weak. So is it time to worry about the labor market?
I think there's reason for concern. We don't see a lot of firing. Today's number was a bit of a head fake. I was on set at 8:30, saw that number jump, looked at the states. And, of course, the states I look at every morning at 8:30, Kelly, are Virginia, Washington, D.C., obviously not a state, and Maryland to see if there's any knock-on effect from the federal government hiring. And I look at the federal thing. There was not a lot going on there. But then New York sticks out, 15,000. Then I started to get a couple notes that the timing of the spring break was different. Apparently, bus drivers are able to file for jobless claims during it. And I never saw this before in 20 years of doing this. Maybe others have. And the reason is because it's usually picked up by the seasonals. It wasn't picked up this time. And so that's a head fake right there. But the key is I think we have had some anecdotal reports, UPS. There's got to be some layoffs in the transportation and warehousing business, at least temporarily. And also, you've heard some business, techs, also NGOs are an area to watch. I don't know, Kelly, if it shows up tomorrow. And it's not necessarily the firings that's the issue. I think it's going to be a lack of hiring, and you have this natural attrition that takes place every month because of retirement. So it could sort of start to head towards the flat line until we get a return of the animal spirits and the confidence that employers need to hire.
And meanwhile, and Mike, I'm sure you caught this, but Secretary Bessent this morning said, look at the level of the 2-year, and it's telling us the Fed has room to cut rates here, I guess, regardless of whether the economy slows much further. The 2-year, what is it, around 3.5, Fed funds rate 4.3. So that's 80 basis points of cuts. The market is priced for more than a full point of cuts. And maybe there is room to the downside. Mike, what do you think?
I think so, Kelly. Thanks for having me on. So, yeah, looking at what the market is priced in, and look, the market might be wrong, but in this case, I think the market is probably mostly right, looking for the Fed to bring the policy rate down more than 100 basis points over the next year. That would be highly problematic if bond market inflation expectations were at levels that said it's inappropriate to do so. That is not the case. So on the 5-year horizon, we've actually had inflation expectations come down 40 basis points from the highs of the year. And this is walking right into at least a temporary supply side disturbance from the tariffs. So that's pretty impressive. And I think to Steve's point, with likely layoffs in the pipeline, the data today was probably a bit distorted. But the Conference Board's measures of the underlying labor market conditions also did soften in the April release. So I do think we're at least looking at a temporary disruption. Risk markets are not looking for a big recession, that's for sure. More of a temporary disruption, and then the Fed basically cushions the blow with sustained rate cuts.
Yeah, and inflation has been this back and forth. And can you unpack the move in the long end? I mean, today rates are behaving very well. So why did we see this spike, going back to early April? And where do you expect them to go now?
Yeah, that was, a very scary moment. It was really 5 days where the 10-year Treasury yield moved up about 50 basis points with massive risk asset volatility. So no one knows exactly what the cause was, aside from the policy choice to go forward with tariffs that were obviously much more complicated and extreme than expected. And there could be a bit of a loss of market liquidity that accompanied that big rise in volatility. There were also some fears that maybe capital flows would reverse with a sudden stop to trade. But things have certainly stabilized. And with macroeconomic expectations rolling over a bit, it would make sense that the 10-year yield would move lower, and that has happened over the course of the last few weeks.
Where do you